$21.5 billion. That's the size of EQT Infrastructure's massive energy deal that just hit the market. The private equity giant is acquiring AES Corporation in what's becoming the poster child for a PE buying spree happening right now across multiple sectors. Why the rush? According to market predictions, the S&P 500 could crash to 35.0 by 2028. That's a potential 30% drop from current levels. Private equity firms like EQT Infrastructure VI, with $21.3 billion in committed capital, are positioning ahead of this anticipated correction. Energy Capital Partners, with 5 years of deal experience and 87 transactions under their belt, is co-leading this infrastructure play. Translation: PE firms are taking companies private before the storm hits. This isn't just one deal, it's a pattern. Bridgepoint Group, Kingswood Capital, and Forager Capital are all making moves simultaneously. In healthcare, we're seeing the Athyrium-Capital merger. Beverages. Keurig is eyeing JDE Peet's. Financial services deals are multiplying with tender offers and exchange mechanisms flying left and right. But here's where it gets interesting. Athyrium Capital just deployed $4.6 billion in similar infrastructure plays. EQT's Infrastructure VI fund shows 60 to 65 portfolio companies already in their pipeline. That's aggressive expansion territory. The common thread: these firms are paying premium prices now to avoid what they see as a massive markdown coming in equity markets. Think of it like buying real estate before a neighborhood gentrifies, but in reverse. They're buying before the crash. What moves from here? Energy infrastructure stocks are getting premium valuations as PE firms compete. Grid modernization and power generation assets are seeing bidding wars. For investors, this creates a two-sided opportunity. Now watch this number carefully. If you're holding energy infrastructure REITs or utilities, you might see takeover premiums. But the flip side, when PE firms go on buying sprees like this, it often signals they expect public market carnage ahead. Risk: you're potentially selling at the top to the smart money. The investment thesis is clear. PE firms with dry powder are moving into real assets before financial assets get decimated. Energy infrastructure offers cash flow stability when growth stocks crater. Key metrics to watch: infrastructure deal premiums, PE deployment rates, and energy sector consolidation velocity. This is the part most people miss. When Bridgepoint, Kingswood, and other major players all move simultaneously, they're not just making individual bets. They're positioning entire portfolios for a different market regime. Contrarian take: maybe PE firms are wrong about the crash timeline. If markets stay elevated longer than expected, these firms overpaid for assets in a competitive auction environment. Energy infrastructure might be peaking just as renewable transitions accelerate. The bottom line: $21.5 billion in energy deals signals PE firms are front-running a market crash. If you own infrastructure exposure, watch for more takeover premiums. If you don't, this buying spree might be your canary in the coal mine for broader market trouble ahead.